All right, so you're ready to start investing. You log into your brokerage and boom, you're hit with a classic choice, VT and VTI. They look almost identical, right? But that one little letter difference, it's a world of difference. It's a totally different bet on how you think the future's going to play out.
So, how in the world do you choose? Well, that's exactly what we're going to break down right now. We're going to walk through this step by step so that by the end, you'll know exactly which one of these powerhouses makes sense for you and your money. Okay, so at the simplest level, here's the deal. Think of VT as owning the entire world. You get a tiny piece of thousands of companies all across the globe. VTI, on the other hand, that's you saying, I'm betting on the USA. You're buying into thousands of companies, but only in the United States. It sounds simple, but the ripple effects of this one choice on your portfolio are absolutely huge. Let's see what I mean. All right, here's our game plan to get this all sorted out. We'll start with the basics, the numbers. Then we'll peek inside each ETF to see what you're actually buying. After that, we'll check out their performance head-to-head, weigh the pros and cons, and then we'll get to the big one. What's your investment philosophy? Let's jump in.
Okay, Section 1, the basics. Let's just lay out the simple side-by-side stats for these two Vanguard titans.
So a few things jump out right away here. First, look at the sheer number of stocks. VT is just massive. We're talking almost 10,000 companies globally. VTI is still huge, but it's much more focused on the US. But here's the kicker for a lot of people, the expense ratio. VTI is just cheaper. It's only 0.03% versus 0.07% for VT. Now, that might sound like pennies, but trust me, over decades of investing, that difference really adds up.
All right, so we've seen the numbers, but what does that actually mean? What are you buying when you put your money into one of these? It's time to pop the hood and see what's really inside. I love this quote because it's so true. You'd never just eat a cake without having some idea of what's in it, right? So why would you do that with your money? Let's go ahead and slice into these ETF cakes and see what ingredients we're working with.
Now this right here is probably the biggest surprise for people who are new to VT. You see total world and you think it's an even split, right? But nope, look at that. The US makes up something like 70% of the entire fund. So yes, you get exposure to Japan, Europe, China, more than 40 countries, but your ship is still very much anchored in the American market.
And then you have VTI. No surprises here. It is 100% pure play, all-American. From the biggest tech giants to the smallest up-and-coming companies, if it's in the US market, it's in here. There is zero direct international diversification. It's an all-in bet on the USA. Okay, this is where things get really interesting. You'd think a world fund and a US fund would look totally different at the top, right? Wrong. Look at that. The top holdings are practically a mirror image of each other. Microsoft, Apple, Nvidia. It's all the same US heavy hitters. So the real difference, the thing you have to pay attention to, isn't who is on the list, but just how much of the fund they take up. So with VT, because it has to make room for literally thousands of other companies from all over the world, those top 10 giants make up about 16.4% of the fund.
But now look at VTI. Because it's only focused on the US, that concentration skyrockets to over 27%. That means you have a much bigger chunk of your money riding on the performance of those top companies. And that difference in weighting, it has a huge impact on your returns, as we're about to see.
Okay, so we know they're built differently. But how has that actually translated into performance? Let's take a look at the race and see how these two have stacked up against each other over time. It's funny. If you just look at a short-term chart, like a day, a week, even a few months, you'd probably have a hard time telling them apart. They move almost in perfect lockstep. And that makes sense, right? Because as we saw, VT is so heavily weighted towards the US anyway, so whatever the US market does, VT is going to follow pretty closely. But when you zoom out, when you look at the last decade or so, a very different picture emerges. The US market has just been on an absolute tear, and because VTI was 100% pure bet on that incredible run, it has, historically, delivered much higher returns than the more globally diversified VT. So, VTI has higher returns. Easy choice, right? Case closed? Well, not so fast. Because as every investor knows, past performance is no guarantee of future results. And that higher performance with VTI comes with a really important trade-off. Let's get into the pros and cons. With VT, its #1 pro is diversification, maximum diversification. If the US market hits a rough patch for a few years, but say emerging markets are booming, you're covered. It's kind of the ultimate sleep well at night fund. But that's also its biggest potential downside. Some call it dis-worsification. Because you own everything, you also own the parts of the world that are lagging, and that can drag down your returns when one area, like the US has been, is absolutely crushing.
VTI, on the other hand, is just a super powerful, super cheap way to bet on America. And historically, that's been an amazing bet to make. The downside, well, it's obvious, right? All your eggs are in one basket. There is no international safety net. If the US economy stumbles, your portfolio is going down with it. You're riding or falling with the US, period.
And that brings us to the final section. Because this decision really, it isn't just about looking at charts and numbers from the past. It's about your own personal philosophy. It's about what you believe is going to happen in the future.
This leads to a really interesting question that investors debate all the time. Can you actually be too diversified? We've been talking about global versus US diversification, but some people look at VTI with its 3,700 stocks and think, is that still too spread out?
And that's where something like VOO enters the picture. VOO tracks just the S&P 500. So it takes VTI and strips away all those thousands of smaller and medium-sized companies, leaving you with just a concentrated bet on the 500 biggest, most powerful companies in America. It's another step down the path towards concentration.
So when you see it laid out like this, it kind of creates a spectrum, right? On one far end, you have VT, which is maximum diversification, a bet on the entire world. In the middle, you have VTI, a highly diversified bet, but just on the USA. And on the other end, you have something like VOO, a more focused, concentrated bet on just the leaders of the US economy. The question is, where on that spectrum do you feel most comfortable?
So in the end, it all boils down to this one big question. Which bet are you making? Are you betting on the world's economic engine, the United States, to keep outperforming everyone else? Or are you betting on the entire world, believing that over the long run, global growth will balance out, and it's smarter to just own a piece of everything? There's no single right answer, but the one you choose really defines your path as an investor.